there's no doubt there's an asset bubble in private credit. Well, lucky us, we have a man who's a veteran in private credit, knows the space very well. What does he think? It is Blair Jacobson, co-head of European credit at Ares Management. Blair, great to see you. Thanks so much for joining Manus and me. I mean, look, even the Bloomberg reporting has shown more players getting into this. Citi wants to start a strategy by early 2024. Nomura is using a $1 billion part of their balance sheet to do into private credit. Does Kelleher have a point? Is there an asset bubble in private credit?
Certainly, everyone's entitled to their view, but I think at Ares, we take a slightly different view. We think private credit is in a long-term secular growth trend, taking share from the banking market. In fact, we see a real supply-demand imbalance at the moment. Commercial banks in Europe are underwriting less. They don't want these loans on their balance sheets. Investment banks have actually been quite quiet for well over a year. That's provided ample opportunity for private credit firms to make very, very sensible investments. So we don't see a bubble at all.
Yeah, the pie is big, I guess.
It's big.
Manus, jump in here.
Blair, good morning. We just had a conversation with one asset manager who structurally wants to be, he doesn't really want to be in investment-grade bonds, but he sees a lot more opportunity in high yield in Europe and in the US. I want to translate that back to your world because set the stage in terms of defaults. He was so bullish on high yield. Set the stage in terms of the default cycle as you see 2024. Will it be higher in Europe than it is relative to the US?
So in terms of what we're seeing in our portfolio today, roughly 170 middle-sized companies in Europe, they're actually still growing. They're in long-term secular growth underlying sectors that don't really map that well to areas of particular high defaults and high yields and bonds. That being said, we're coming out of a relatively low default environment, and our view is that liquidity is going to be the big question in 2024 as these companies adapt to a higher rate environment. Because remember, there's a lag effect here. Our companies pay interest twice a year, so it does take some time to wend its way through the system.
And so, I mean, in private credit as a whole, not necessarily Ares, if liquidity is a concern for you, could we see something that looks akin to liquidity crunch next year?
So when we talk about liquidity, it's really more at the company levels because, again, companies that were setting up their loans 3, 4, 5 years ago did not necessarily anticipate the current rate environment, the current macroeconomic environment. So their interest costs are going up 30, 40, 50% if they're not hedged. And this is really the beauty of the private credit asset class. They deal with a single lender most of the time, like Ares, and these are problems that we can work out together.
So then that takes us to S&P. I mean, as you say, we're looking at a structure of a market next year. S&P say that they're going to start asking to rate private debt funds because of the risk. People want more information. And I suppose what Dani and I thought about was, you know, would you open your books? Would you be happy to do that? In terms of giving more information, would you welcome this kind of move?
So I'd say, first off, we do welcome transparency in the asset class. And in fact, as it relates to rating agencies more broadly, we have lots of limited partner clients, insurance companies, for example, that in order to hold these loans on their books do need some kind of rating. So again, I think we would view that as a positive for the overall asset class. Now, again, the risks are really twofold. The first is that the loans themselves are illiquid. We hold them on our balance sheet through maturity. And the second, the companies tend to be in middle size, i.e. not large cap. So from that perspective, again, I think the asset class has a 20-plus year history of managing those types of loans very, very effectively.
Speaking of large cap, we've got a new record for private lending, 4.5 billion euros for Adventa. Wow, I butchered that one, Blair. Thank you for your help. Are we kind of at the limits of how big private lending deals could be? And if not, how much bigger could we see?
So I'm not sure we know the limits yet. Again, this is a trend that we call convergence, where private capital providers are raising larger funds. We're more relevant to larger businesses. We saw the trend first in the U.S. Now it's coming to Europe. And again, since the capital markets have been very, very quiet, at least for the past 18 months, we think there's a lot left to go for in the large cap side.
Well, tell me this. I mean, we've had a whole series of conversations since we launched Bloomberg Brief within private credit with different asset managers. The world and his wife is arriving in your business and in your sphere. So,
who says the world isn't a woman?
Well, you know, let's put it this way. There are many actors arriving in your marketplace. I mean, you've got a host of people coming in. The question Dani and I had is, how crowded is this becoming? Is this going to put a squeeze on fees? Is this a race to the bottom in terms of participation? We've seen this commoditization of various markets before. So just give us the context of that commoditization.
Sure. I think when we look at the market in particular in Europe, we estimate it's roughly a 1 trillion market. There's something like 700 to 800 loans written every year by private investment firms to middle market companies. So I think from our perspective, as I mentioned earlier, there's still a bit of a supply-demand imbalance. In fact, in the current environment, it's going the other way. Much of the discussion in the markets is around this being a golden age for what we do, with higher returns achievable, 10 to 13%, while taking lower LTV and leverage risk and having tighter documentation. So again, we think there's a lot left to go for.
And in this environment, we have seen private equity be pretty accommodative, happy to put up more money for cash-strapped firms. Do you see that changing at all?
So I think the baseline there is that when many of these deals were set up, private equity might have been 50, even 60% of the capital structure. So they have a lot in those businesses, and there's a lot to lose. If you compare that to, say, deals set up pre-GFC, those might have had 20 or 30% equity. So we've actually seen exactly the trend that you've mentioned. Private equity's been very accommodative. They backed businesses with additional equity when it's been needed. They've divested divisions, for example, to reduce debt burden. So overall, I think they've been...
That will continue, you think?
I think it will. I mean, there are some natural limits because obviously they raise funds, but they're thinking about other ways to get capital into these businesses. We're seeing increased issuance of NAV loans at the fund level. We're seeing companies themselves bring in subordinated capital to help fill the gap. So I do think that this will sort itself out in the mid and long term.
We can't let you go without talking about remuneration, because people are going to tune in and they're going to wonder where they're going to make the connection for next year. You've got this cracking Goldman story that they're going to revamp the asset management, giving a little bit more to the teams on the carry. You've got Apollo and Carlyle also saying that they're going to do more. What are you going to do? What is your message at Ares in terms of bumping the payouts to bring in the talent? Do you need to?
I think from our perspective, we've always insisted on a significant alignment of interest with our investors, who frankly demand it. They want skin in the game. That means investing in our funds alongside our clients, but it also means a significant portion of compensation will also come from the profits generated by the fund. So again, I think that alignment of interests will continue. And in fact, it does help to benefit some of the larger players in the industry, because this is one where scale benefits compensation and other key metrics.
All right. I think some people will be happy to hear that. Blair, thank you very much. Blair Jacobson of Ares Management.